Welcome back. The mainstream financial press thrives on misdirection. They obsess over the Federal Reserve. They debate interest rate adjustments endlessly. They parade charts of technology stocks across your screen, desperate to convince you that the fate of global markets hinges on a handful of trading desks in Manhattan's financial district. Their narrative demands you believe that every price, every valuation, is dictated by traders in tailored suits staring at terminals in New York City. But while these so-called experts fixated on basis points, while the high-frequency algorithms shuffled paper contracts in milliseconds, an event unfolded halfway across the globe that renders Wall Street's machinations utterly insignificant by comparison. For the past several months, our team has monitored the silver market's systematic tightening. The premiums climbed steadily higher. The inventories contracted relentlessly, yet one critical piece remained obscured. We documented the metal evacuating Western vaults, but the identity of the ultimate buyer remained hidden in the shadows. Our initial suspicions centered on China. Perhaps industrial conglomerates were quietly stockpiling. The answer, however, exceeded our most aggressive projections. The whale has finally broken the surface, and its identity should terrify every paper silver holder on Earth. This buyer isn't a hedge fund executing a speculative trade. This isn't a technology corporation hedging supply chain risk. This isn't even a central bank diversifying reserves. The buyer is India, the entire nation. We've just obtained trade statistics so extraordinary, so statistically anomalous under conventional market dynamics, that they demand we completely reconstruct our understanding of precious metals, supply, and demand equilibrium. According to verified customs data, India has absorbed approximately $5.9 billion worth of silver across merely the previous 4 months. Let that magnitude settle in your mind for a moment. $5.9 billion deployed into silver, a market dwarfed by gold, oil, and virtually every other commodity. This transcends standard investment behavior. This represents nothing less than a coordinated market takeover. Historical precedent provides the only lens through which we can comprehend this anomaly. Between 2013 and 2019, India's annual silver imports averaged roughly $1.5 billion across 12 full months. Digest that baseline, $1.5 billion per year represented normal, sustainable demand patterns for an entire calendar year. India just consumed nearly $6 billion in 16 weeks. That represents a 400% surge in acquisition velocity, not a gradual uptick, not a seasonal fluctuation, a fourfold detonation of demand that obliterates every historical comparison. Even measured against 2022, a year traders already classified as exceptional, record-shattering territory, this current accumulation campaign registers 64% higher. We're witnessing what systems analysts call a step function discontinuity. The graph doesn't slope upward, it goes vertical. It's the acoustic signature of an entire nation collectively deciding, seemingly overnight, that physical silver outweighs every form of fiat currency on their central bank's balance sheet. But you might be asking, why does this matter to someone residing in Dallas, London, or Frankfurt? Why should activity in Mumbai or Delhi command your attention? The answer is brutally simple. Silver exists as a globally traded asset with a finite above-ground supply. Only so many ounces exist in refinable, deliverable form. When a single buyer emerges and systematically consumes 4 months of worldwide production in a single quarter, those ounces vanish permanently from available inventory. They're removed from the chessboard. The silver India is acquiring didn't materialize from thin air. It originated from the London Bullion Market Association vaults. It shipped from Swiss refineries. It departed warehouses that supply the COMEX futures market. India is executing a systematic drainage operation on Western reserves. And here's the detail that mainstream commodity analysts consistently miss in their reductive narratives. They'll dismiss this with patronizing explanations. Oh, it's merely jewelry demand, festival season, cultural traditions. They want you to believe this represents Indian grandmothers purchasing decorative bangles at the local bazaar. They're either incompetent or deliberately misleading you. You don't import $6 billion of industrial-grade silver in 16 weeks to manufacture wedding jewelry. That volume telegraphs something fundamentally different. It signals industrial hoarding combined with investment-grade panic purchasing. Consider India's accelerating infrastructure modernization. They're constructing enormous solar energy parks across their subcontinent. They're scaling electronics manufacturing capacity designed to compete directly with Chinese production dominance. These sectors consume silver voraciously. They require it for photovoltaic cell construction. They need it for electrical contacts and conductivity applications. Indian industrial strategists aren't naive. They're analyzing the identical data we scrutinize daily. They observe the structural mining deficits. They track escalating geopolitical fragmentation. And they've reached a calculated conclusion. Front-run the inevitable shortage. They're acquiring physical metal at $90 to $94 per ounce today, because they understand that waiting 6 additional months might mean no silver becomes available at any price. This represents strategic resource accumulation at the nation-state level. The financial markets in India are broadcasting confirming signals that validate this thesis. Examine the Nifty Metal Index, the benchmark tracking major metal and mining corporations throughout India. It's posting its strongest year-to-date performance since 2018. The ratio of this metals index relative to India's broader equity market has reached an 11-year peak. What does that data point reveal? It confirms that sophisticated capital in India is rotating out of general equities and into hard asset exposure. They're liquidating paper claims and acquiring tangible resources. They're selling future promises and buying present reality. This constitutes a macro-scale portfolio rotation of extraordinary magnitude. And because India operates at such enormous scale, when their capital rotates, the entire global system registers the seismic shift. The worldwide silver market currently operates in structural deficit. Annual consumption exceeds annual mining output. That gap has been filled for years through above-ground stockpile drawdowns, but those accumulated reserves are finite and depleting rapidly. When a new buyer enters with a $6 billion checkbook, they don't just participate in the market, they obliterate the surplus. They consume the buffer that prevented price volatility. This explains the price behavior we've been documenting. It explains why every price decline gets immediately absorbed. It explains why the bullion banks can't successfully suppress prices for sustained periods anymore. Every time New York or London drives the price lower, Indian buyers interpret it as a discount opportunity. They step in and sweep available inventory off the table. They function as the permanent put option beneath this market. The Western banking establishment is attempting to play poker with mathematical precision. India is playing hungry hippos. They're just grabbing everything visible on the table. This 400% spike in import velocity isn't speculative froth or algorithmic manipulation. It's driven by physical metal delivery, actual tonnage crossing international borders and clearing customs. Paper markets can be manipulated through infinite contract creation. You can print derivatives until your servers overheat. But you cannot fabricate a customs declaration. You cannot falsify 6 billion of physical silver crossing a sovereign border. That metal must physically exist. It must be refined to deliverable purity standards. It must be shipped through physical logistics networks. The logistical implications alone are staggering. We're discussing thousands of metric tons of silver being transported from Western hemispheres to Eastern destinations. This creates what we call a logistical vacuum. If every available shipping container and secure transport vehicle is booked solid to move silver to India, zero capacity remains to redirect silver to New York to cover a potential short squeeze. The supply chain is being monopolized by the dominant buyer. This is the same pattern we witnessed in 2011 when JP Morgan accumulated physical positions while shorting paper. It's the same mechanism that operated in 2020 when the COVID supply chain disruptions exposed the paper-physical disconnect. When physical demand overwhelms paper manipulation, the fraud collapses. So when you observe silver hitting 94.68 on your price charts, understand that this isn't merely a number fluctuating on a screen. It represents the outcome of an ongoing bidding war. The Western establishment wants to suppress prices to protect dollar hegemony. The Eastern Bloc wants to own the physical metal to construct their economic future. The East possesses more available capital, and critically, they're operating with greater desperation. India has effectively installed a price floor underneath the silver market. If silver declines, they acquire more. If silver rises, they acquire more. They're completely price inelastic because they view silver not as a trading vehicle, but as essential wealth preservation. This Indian whale represents the force that finally broke the cartel's back. The bullion banks could manage retail buying pressure. They could absorb moderate industrial demand. But they cannot withstand a sovereign nation deciding to corner a global commodity market. And India isn't operating in isolation. They're simply the most visible actor currently. While India vacuums supply from London, China is executing something even more aggressive. The mainstream media is spinning this as cultural demand and festival purchases. Bloomberg runs headlines about jewelry consumption. CNBC interviews analysts who dismiss this as temporary seasonal patterns. They want you to believe this is normal. They want you to remain complacent. But the numbers don't lie. A 400% surge isn't seasonal. It's strategic, it's coordinated, and it's permanent. While the Western markets were congratulating themselves for reaching $94, something far more significant was occurring on the Shanghai Gold Exchange. Silver prices there have exploded to $105 per ounce. The premium over Western prices has reached $11, a spread that shatters the previous record highs from 2011. But more critically, we need to examine the export restrictions. China functions as the world's manufacturing hub. They process enormous quantities of silver, and now they're refusing to allow it to exit their borders. India is draining the metal, China is locking the gates on the metal, and the West is left holding an empty bag. The global squeeze isn't theoretical speculation anymore. It's a $6 billion customs receipt combined with Chinese export bans. Let me walk you through why the Shanghai premium matters so profoundly. In a functioning global market, prices equilibrate through arbitrage. If silver trades at $94 in New York and $105 in Shanghai, traders should theoretically buy in New York, ship to Shanghai, and pocket the $11 spread minus logistics costs. But that arbitrage mechanism has collapsed. Why? Because China won't let the metal leave once it arrives. They've implemented what we call a roach motel policy. Silver checks in, but it doesn't check out. This means price discovery is fragmenting geographically. There is no longer one global silver price. There's a Western price and an Eastern price. And that $11 gap represents the true premium the world is paying for physical metal that Western paper markets refuse to acknowledge. The Chinese government didn't wake up one morning and randomly decide to restrict silver exports. This represents calculated economic warfare. They understand that silver is essential for Western military technology, solar infrastructure, and 5G network deployment. By controlling the export valve, they control Western access to critical materials. This isn't about trade policy. It's about resource leverage in an increasingly multipolar world. And here's what should terrify Western policymakers. China produces approximately 3,500 metric tons of silver annually. If they simply retain their own production for domestic use and refuse to export, they remove roughly 11% of global supply from international markets immediately. Combined with India importing $6 billion worth, you have the two most populous nations on Earth simultaneously draining and hoarding silver. The mathematics don't work. The West cannot outbid this level of demand. Now let's discuss why this demand is completely inelastic and why industrial buyers will pay any price. Silver isn't optional for modern technology, it's mandatory. Solar panels require silver for photovoltaic cell efficiency. There is no viable substitute that matches silver's electrical conductivity. Electric vehicle charging systems need silver contacts. 5G network infrastructure depends on silver's properties. Military defense systems, missile guidance, radar, electronic warfare, all consume silver. Tesla's gigafactory battery production requires 47 ounces of silver per megawatt hour of storage capacity. Lockheed Martin's hypersonic missile program uses 18 ounces per unit. These aren't discretionary purchases. These are mission-critical inputs. When First Solar's CEO states publicly that they're willing to pay whatever is necessary to secure supply, believe them. Military contractors don't care about premiums. They care about contract fulfillment and national security clearances. These industrial buyers are taking physical delivery, they're building private inventories, they're signing long-term supply contracts at prices $6 to $10 above spot, and they cannot be margin called, shaken out by volatility, or discouraged by price manipulation. The Nifty Metal Index in India is delivering its best annual start since 2018. This index tracks the major metal and mining corporations listed on Indian exchanges. When this sector outperforms the broader market, it signals capital rotation at scale. The ratio of the Nifty Metal Index to the Nifty 50 benchmark has reached an 11-year high. What does that tell you? Sophisticated institutional capital in India is exiting general equities and piling into commodity exposure and hard asset plays. They're not buying tech stocks. They're not buying bonds. They're buying exposure to physical resources that cannot be printed, diluted, or defaulted on. This is a macro rotation of generational significance. And because India represents such enormous scale, 1.4 billion people with rapidly growing wealth, when they rotate, the entire world feels the tremor. Now we must connect this to the broader geopolitical context. The United States has implemented tariffs on numerous trading partners. China has retaliated with its own tariffs and export restrictions. The European Union is preparing countermeasures. We're entering a period of deglobalization where supply chains fragment along geopolitical fault lines. In this environment, countries prioritize domestic resource security over free trade principles. This is why India is hoarding silver. This is why China is banning exports. They're preparing for a world where you cannot simply order commodities on the global market and expect delivery. You must own the resources within your sphere of influence. And silver, being both an industrial metal and a monetary metal, becomes doubly critical. You need it to build your economy, and you need it to preserve wealth as fiat currencies devalue through monetary expansion. This brings us to the most important question we must answer. What happens when the Western banking system can no longer deliver on its paper promises? What happens when COMEX inventories hit zero? The verdict is unavoidable. The era of cheap, readily available silver has ended. It terminated on Tuesday, January 20th, 2026. We are now entering the era of the global roach motel. We discussed the roach motel concept regarding U.S. tariffs earlier. Silver checks in, but it doesn't check out. But this policy has now gone global. China operates a roach motel policy through export bans. India operates a roach motel policy through massive import duties and strategic hoarding. The United States is implementing a roach motel policy through tariffs on the UK and Europe. Every major power is constructing walls around their silver reserves. They're hoarding domestically because they recognize they cannot function without it. This means the global pool of liquid silver, the metal that used to flow freely across borders to balance prices, has evaporated. If London needs silver, they can't source it from New York. If New York needs silver, they can't acquire it from Shanghai. This fragmentation guarantees volatility. It guarantees that prices will disconnect across regions, but ultimately it guarantees that the price in the cheapest market must rise to meet the price in the most expensive market. Right now, the United States is the cheapest market at 94 by 68. Shanghai is trading at $105. Do you believe that gap will persist? It cannot. The arbitrage opportunities, the smuggling incentives, and the desperate industrial buyers will attack that spread until it closes. They will purchase every available ounce in New York until the price hits $105. We're looking at a 10-plus gap up that is mathematically inevitable. This isn't speculation, it's hydraulics. The water level must equalize. If you are holding physical silver, recognize that you are now holding an asset in a fragmented market where premiums are becoming structural and permanent. The 20-plus premium on American Silver Eagles isn't temporary volatility, it's the new baseline reality. Your stack just appreciated not because the paper dollar price moved, but because the physical metal itself has become regionally scarce and internationally contested. If you are considering entering this market, understand that the window is closing faster than anyone anticipated. The Indian whale accelerates every trend we've been documenting. It makes domestic supply more valuable. It makes foreign supply more expensive. It separates those who hold metal from those who hold paper claims to metal that doesn't exist. If you remain skeptical, ask yourself why a sovereign nation would deploy $6 billion into a commodity market in 16 weeks. Ask why premiums are exploding while spot prices remain suppressed. Ask why mints are suspending sales during an alleged price correction. The data is conclusive. The pattern is unmistakable. The only question is whether you will position accordingly or remain frozen in normalcy bias. Do not sell your physical metal to chase paper profits on short-term price movements. Do not assume the premium will shrink back to historical norms. Those norms are dead. Do not wait for lower prices that may never materialize. Do not trust allocated accounts at institutions that cannot show you the physical metal on demand. Do not believe the narrative that supply will increase when the largest refiners on earth have been cut off from the largest market by export bans and tariffs. Rule number 1, hold your physical silver. The Indian whale proves the system is fragmenting. Ounces held in your direct possession cannot be hypothecated, rehypothecated, or cash settled when delivery failures occur. Rule number 2, understand that the premium is the price. Spot price is a fictional benchmark created by paper contracts that vastly exceed physical metal available for delivery. The premium is what real buyers actually pay in the physical market. As markets fragment, the premium becomes the only reliable measure of true value. Rule number 3, prepare for force majeure events. If LBMA inventories continue depleting at the current pace, we will witness delivery failures by Q2 2026. When that happens, allocated account holders will be offered cash settlement at spot prices far below physical market prices. That's the end game for paper silver holders. Be ready. Rule number 4, diversify your acquisition sources. Do not rely on a single dealer or mint. As supply tightens, some will prioritize long-term customers. Build relationships with multiple dealers now. Secure supply chains before the panic arrives. Rule number 5, ignore volatility in paper markets. Your physical silver doesn't change value because a futures contract dropped 3% in overnight trading. The ounce in your safe is the same ounce it was yesterday. Price discovery is migrating from paper to physical. That transition will be violent and chaotic. Your metal is your anchor. We are currently sitting at $94. We are $6 away from the most psychologically significant price level in silver market history, $100. When silver crosses $100 in New York, and based on the Shanghai lead time, this is imminent, it will trigger a media frenzy that dwarfs current coverage. Headlines will scream, silver hits triple digits. Dollar collapse accelerates. Hyperinflation arrives. This media cycle will trigger the final wave of the retail tsunami. The general public, who ignored silver at $20 and dismissed it at $50, will finally capitulate and buy at $100. Why? Because humans are momentum chasers. They require social proof, and a 3-digit price tag is the ultimate social proof. It validates the asset as real in their minds. But here's the danger you must anticipate. When the public arrives, the banks will attempt one final manipulation. They understand the public trades emotionally. They know retail uses leverage, so right around the $100 level, expect the mother of all rug pulls. The banks might allow it to run to $112, then smash it back to $88 in a single hour. They will try to flush out the late arrivals. They will try to steal positions from weak hands who bought the top with margin. Your strategy must be forged from steel. Strategy number 1, do not trade the breakout. If you attempt to day trade the move to $100, you will get destroyed by volatility. The price swings will be violent. You'll see $5 candles in both directions within minutes. The only winning strategy is radical inactivity. Sit on your hands, observe the spectacle, let the banks battle the whales. You already possess your metal. You don't need to do anything. Strategy number 2, monitor the street price, not the paper price. We know from dealer reports that physical silver is already trading over $120 in some markets. Even if the paper price corrects sharply, the street price will likely hold firm. This premium is your shield. It insulates you from paper market manipulation. If COMEX drops $10 but dealer premiums rise $10, your net worth hasn't changed. Strategy number 3, adopt the wealth transfer mindset. You're not holding silver to accumulate more dollars. You're holding silver to acquire more freedom, more optionality, more sovereignty. The $50 billion bond sale by India, the trade war escalations, the export bans, these are all symptoms of a dying currency regime. The dollar is losing its privileged status as global reserve currency. When you eventually sell your silver, do not exchange it for cash that's being printed into oblivion. Exchange it for assets that produce value, land, productive businesses, income-generating real estate. Sell it to eliminate debt. But do not sell it merely to see a bigger number in your bank account. That number is an illusion denominated in a debasing currency. You have held through the 2023 banking crisis. You have held through COMEX margin hikes. You have held while the media called silver a barbarous relic and told you to buy tech stocks and index funds. You were right. They were wrong. This Indian whale is proof that the physical silver shortage is real. It's proof that the paper market is losing control. It's proof that governments are resorting to export bans and strategic hoarding because normal market mechanisms have failed. You saw this coming. You positioned accordingly. You will be rewarded. The global squeeze is the mechanism by which the world resets its financial ledger. It's transferring wealth away from the paper pushers in London and New York and returning it to the producers and the savers in the real economy. You are part of that real economy. You hold real metal. You have skin in the game. As we close this investigation, remember where we stand. We have the Indian whale deploying $6 billion. We have the Shanghai market paying $105. We have the U.S. government terrified of a shortage. And we have a price that is just beginning to wake up to reality. $94 is not the top. It is the breakout point. The squeeze is global, the shortage is structural, and the opportunity is generational. Thank you for being part of the boring currency community. We know these are volatile times. We know the news is moving at unprecedented speed, but we will be here tracking every ounce, every vault withdrawal, and every lie. Leave a comment saying staying with the original to let us know you are part of the real team. It helps us fight the noise and the algorithms. The world is changing. The wealth is moving. Don't let go of the rope.